Logan. I'm the Director of Philanthropy Investing here at Equity and Help. I'm super excited to talk about today's topic. It's a topic we talk about quite often. And so we'll kind of be going through this and see what we have. So my tech is going to handle a couple things real fast. All right, let's go here while the other stragglers are popping in. Let's see. All right, so there I am. Good day, good day. So I am Skye Logan, Director of Philanthropy Investing here at Equity and Help. I am super excited to talk about today's topic. Cash is king. Okay, we've all heard that saying, or even newer, cash flow is king. All right, so what is this thing? Cash is king. And we're going to discuss this. I'm really curious on where you sit on that fence. It's kind of a big topic, almost as big as religion or politics or, what school your kids should go to type of topics. Cash flow or what? All right. So, like I mentioned, our topic today we're talking about is cash is king. All right. So now there are two types of returns in your investments. All right, so it's either growing, you got your capital growth, or it's cash flowing, generating. Okay, these are kind of your two key types of returns in your investments. All right, so what are these? I'm going to go over some examples of these and discuss these. Feel free to chime in if you have some questions on that. I'm curious, what side of the fence you sit on or what you believe, or I'm really curious if you think one thing, we move through the webinar, and then you're going to be thinking something completely different. I kind of in the game of changing men's minds. So I'm really curious how that goes about there. All right. So there is a chat window there. Feel free to add anything into the chat if you have some questions, and I'll catch that and we will kind of discuss those. Okay. All right. So I'll put that there. All right, so as I mentioned, two types of returns you're investing. All right, so we're gonna look at these. All right, now one thing you need to assess on yourself, on your type of investing, just like anything through life, you need to assess, who am I? I've talked about this in a previous webinar, and really assessing yourself in a lot of different aspects in life. All right, now as far as we're talking right now, as investments go, what can you tolerate? What are you comfortable with? Okay, if you look at this scale here, you've got this high risk area, you've low risk. Are you a little bit more conservative, or you want to be highly aggressive? Now, like many things, the returns, the higher risk is going to get you some. If you're highly aggressive with it and you're just Johnny on the spot and that's just all you do all day long, there's a possibility of having a higher returns. But again, with that comes certain sacrifices, just like anything in through life. The more attention units you put on A, it's obviously taking your attention units away from B, C, D, etc. Myself, I'm a family guy. I have a lot of other things that I'm doing philanthropy-wise, humanitarian-wise. I don't have the attention units to focus all day long looking at, like day traders or whatever. You have to be Johnny on the spot on those. They're highly aggressive, okay? Or they're somewhere in this area. Now, you as an investor, maybe you pay someone else to be this for you because you're not that. But you'll notice the question is, as your investments appreciate, you're investing in some equity, some securities in different businesses, a lot of those returns are going to be invested within that company. Okay, so with the capital gains, with that growth in that company, you can have a higher possible return in that, as opposed to a steadier dividend. And I'm going to discuss that in a couple slides later. So I'm kind of jumping the spot just a little bit. But if you are doing a highly aggressive model, okay, so you're jumping in here, this up and down constantly. I'm going to show a couple examples of some securities here in just a moment. But a lot of people want to get into this point, this euphoric point, this emotional. It's almost like anything in life. You know, we kind of get bored as humans, and we want some type of thrill because we don't like doing roller coasters anymore. So we're going to convert that over to our investments, you know, and the thrill and the euphoria of, you know, everybody caught news of Gamestop, you know, or other stocks when they're like, oh my gosh, you know, the Tesla stock, look at this. I have buddies always telling me about this or that or other things. Whee, right? And then all of a sudden it going back. But the problem is this, no one likes this point of it. And you get this herd mentality when everyone's buying in, and this emotion. So this is a slide mainly going over this emotion that happens, you know, this anxiety, this fear, depression, of this up and down. Now, to give you some ideas of some of these numbers. So 1971 to 2019. So you've got this curve. I love this. Kind of shows that same curve up here above from 1971 and 1974. You had this 34%, this recession period. All right, then it goes, woo, goes right back up. Then it goes back down. 1987, right? You've got this 28% quote unquote market crash. Okay. No one likes it at that point, but everyone's back in this roller coaster. In 2002, what do you have? 22%. You got different accounting scandals that happened during that time. This really long period, this bear market that happened. All right, then you have 2008. We all remember, you know, for sure, this 2008, this housing crash that happened that affected the global markets all over the place, just here in the U.S. due to the out ethics and things that were taking place. But a 37% drop, okay, in this global market crash. That's huge. All right, so you've got this constant woo happening, and on that scale of highly aggressive to more steady, a more comfortable, steady return. Okay. Now, these are some of the securities I was talking about. All right, Dogecoin on the left-hand side here. You've got this monthly volatility on the right. Okay, this past week. So look at this. So everybody hops in at the point whenever it's like woo, right, going up, and then everyone starts bailing back out. All right. Okay, these meme stocks, as they say. All right, and then you've got Gamestop. I talked about. All right, so this is over a whole month. Okay, look at that. This is previously when everyone like, oh my gosh, everyone hop in, then everybody hop out. Everyone get in the boat, get out of the boat, get in the boat. You know, all this stuff. When you actually look at your gains throughout this period, you actually had zero gains if you had those stocks, because it just ends up dropping back to this period. This is a month-to-month view on this GameStop stock. Okay, again, so this aggressive, this trying to get this the quick gains in that, and unfortunately, it's just this herd mentality. If you're early enough in that, if you're buying in this Dogecoin back here in this point and you wait through it and you're selling at the top, like a lot of these top investors might be doing or whatever, but everyone else they don't have that inside scoop. They're not paying attention. They lose out. Okay. I know quite a few people lost money on this GameStop stocks. Okay. Enough for them to completely get out of investing in securities, the speculative investments, because I don't want to say it broke their banks, but they lost big time in that. Okay. So now cash flow, this appreciation growth. Now let's look at these different scenarios. So I really want to get into why is cash king? So before I get into this, cash is king. Okay. One, that may be true, but it depends on the scenario. let's look at a couple scenarios just on the cash is king. Then we're going to talk about the cash flow as opposed to the appreciation growth. Cash is king. All right. You're buying a house, $500,000 house. There's 4 offers in on the property and they're all financing. In that instance, cash is probably king. Okay. If you come in bidding even 5,000 under them sometimes, that seller might just take that cash and go, okay, I don't have to wait for financing. I don't have to wait just good 30 days. Cash is king is fantastic in that scenario, but different scenarios, it's not good. Let's say you have a walk-in safe as big as this, right? Full of cash. Why does no one just let cash sit in a huge safe? What happens to it? It depreciates. Cash is not king in that scenario. Everyone puts gold in there or silver or something else, not a US dollar or any currency depreciates. So cash is not king in that scenario. So that datum, you have to be intelligent enough to, anytime a datum comes in, you need to be intelligent enough to actually evaluate it. Is that true? Is that true for me? Is it true in this scenario or all scenarios, or what kind of datum weight should I put on that? So you have to determine that. Now, cash flow is king. So what is that? Obviously, it's generating this money. So let's give example. In general investment world, people have a 401k or they invest in securities. So let's look at one scenario here. So investor number 1. All right. So he's slaved for 30 years. He's working for a salary and a job that wasn't his dream job. Okay. His boss made his life difficult. It was really difficult to manage all through that, but he's got a good paying job. He's got his 401k, or it's going in, this is being managed, etc. He was diligent. He constantly put money away. He wanted to provide for his family's future. So he ended his career making a salary of $150,000 a year. Okay, we'll do an apples to apples in the next one as well. $150,000 a year. So he followed the traditional advice of putting everything into low-cost mutual funds or exchange trade funds, ETFs. So he's able to build his net worth to $2 million. Nice, right? All right. So he's ready to retire, but he's still unsure he'll have enough to last. So he obviously has a standard of living right now. Okay, so he's got to determine that. You got to determine what your standard of living is now compared to what you want it to be then, etc. So his financial advisor is telling him he can safely withdraw 3 to 4% per year out of that investment. Okay, so let's just call it 3%. We'll err on the side of safety and say 3%. So his before-tax annual cash flow is going to be about $60,000 a year out of this investment at 3%. Okay. Now, $60,000 is nothing to laugh at necessarily. And surely his expenses are going to be less. So once he's maybe paid off a house or paid off a car, so maybe expenses a little bit less. But he was used to making $150,000. That was his standard of living. His income has dropped from $150,000 a year to $60,000 a year. Even if he has less expenses, that's huge. More than half, right? So he's definitely going to have to downgrade his lifestyle. Further, what is $60,000 worth 20, 30 years down the road? Okay. So the expected future performance of the stocks. So you also have on top of that $2 million in a crash. What happens to that $2 million? I had this happen to my own dad. Worked hard, 35 years in the city services, fireman, paramedic, etc. $400,000 later, he lost a big chunk of that, $285,000 left after a huge drop, plus the dollar's worth less. So these are the things you need to actually look at. Okay, so anyways, you got to evaluate that. Okay, so there's no actual hard assets to back that up. It's a stock. It's a significance. You're investing in what people's belief in that company, security, or whatever it is that you're investing in a belief. If everyone 30 years down the road now believes that's worth nothing, what have you got? Right? All right, so let's look at scenario number 2. So investor number 2, she's young. She's only been in the workforce for about 10 years. She makes a good income at $80,000 a year, but has a lot of room left to run. She's got a lot of earning power, right? She's only been working for 10 years. Okay. So instead of just focusing on growing her salary, every single dollar, every single penny that she's had, she's accumulating assets, hard assets. Okay, investments that are actually generating this cash flow, building that up, cash flow. All right, she's purchased several single-family homes. She's bought mortgage notes. She's done a lot of different things. She's a passive investor. She's invested in some multifamily units, mortgage notes, etc. So overall, her annual return is 10%. Okay, nothing massive, but it's just 10% on those and that growth. Okay, and that's not uncommon at all. So say she works a full career, similar to, so again, apples to apples. So we're going to look at the other gentleman. So she works a full career. Just like number one, he built his $2 million. So let's just say for her sake, for apples to apples. So she has this $2 million in these assets. Okay. So also she ends her career making $150,000 a year. However, instead of mindlessly putting money away in the stock market, she's gone against this tide, and she's continued to build her investment portfolio with various types of real estate notes, oil, gas, etc., any type of some various alternative notes. Okay. So this $2 million here is annual yield at 10%. Look at that cash flow difference. Okay. So you need to evaluate what it is you're investing in. And this is all obviously significance. You know, this is hard assets or cash flowing. Okay. Annual yield 10%. Look at that difference. She's actually not going to be going down. Her earning potential previously was $150,000 a year. Okay. So this is a common look that in my strategy planning with the clients that are coming in, we actually look at. So we're considered an alternative investment. It's backed in real estate. You actually have a hard asset. Your money, your dollars are spent to buy something. One, it's at the lowest it's going to be. We buy foreclosure, pre-foreclosure, etc. There is nothing but upside to that. So the loss factor of it, depreciation, you don't have to worry about that like a stock or equity, a lot of other investment types. Now, on top of that, what you have here, this is a $500,000 investment. I do all kinds of planning with individuals, but this orange line here, what you're looking at is this is the revenue, okay, the monthly revenue stream. The blue line is the number of properties. So they initially bought 11 homes. So what I show here is a mix. So one, you're growing the capital. So there's this appreciation because you're reinvesting it in that portfolio for capital growth. On top of that, what I have said here is you're taking out 50% cash flow. So when you're younger, you're still a strong earner in the workforce. You don't need this as much because you're already making your cash. You're a doctor, you're this, you're that, whatever you are, you're an income earner. All right. You could actually get more aggressive and not take out 50%, put more of it in. It just grows better. But let's just say you take out, we're doing both the best worlds. The best of both worlds actually is the same. You're growing the capital and you want a cash flow. But look what, this is unkillable. Look at that. By the time this is done, you are cash flowing $11,000 a month and your portfolio is still growing. Crazy, right? It's unkillable. As long as there's a certain percentage, it's just unkillable. It just keeps growing. So this is the intelligence in looking at evaluating the data as cash is king or cash flow is king. Okay, if cash flow was fully king, I was taking out 100% at the beginning. Would I have this growth? No, I mean, it would get up to a certain point and it would kind of just stagnate along. But doing this mix is highly intelligent. Okay. So I'll give you an example. So here's a sample portfolio. So this shows one's potential returns, income. This is 2020. Okay. Money's not stuck. It's actually in hard assets. And so this particular client, this portfolio is obviously just generating this money every single month, right? Up to, what was that, about 50,000 a year in this portfolio. Okay. Give you an example. All our portfolios, this is just a snapshot from our portal. All our clients have access to this. They can look through all this stuff and see how their portfolio is generating. They love it. Okay. So how does Equin Help do cash flow? Now, here's a real client case study. So this is going to show you the same time period comparing our equity and help system to stocks, various different stocks, to funds. All right. The solid green line, of course, is the equity and help. Look at the same time period. So this is at the peak of the coronavirus over here in this period, right? Obviously, everyone remembers March of last year, 2020. Look what happened here. If you had money in stocks, boom, you know, it still hasn't done a full recovery, right? Or even any type of funds. Look at that. Downtrend all through here, slightly up, but you're sitting slightly down, but almost even with that. But equity and help, there wasn't a dip at all. None of our portfolios had that dip that occurred like these other investments, period. Right? So that's a security. You're working your life, you're working hard. You need to intelligently assess what is good for you. What is good for me and my family, given any kind of circumstance that happens in the market. You cannot control what happens in the market. You have no idea. Nobody last January was going, uh-oh, I perceive something's coming, or I'm going to control that. If the coronavirus and the economic shutdown, all that stuff, it's just too big. It's too big of a monster to control that. But what you need to evaluate and what you need to set up your portfolio for is something that mitigates that loss. If you're still doing the stocks, if you're still doing that, good. Maybe you do all three of these. Great. But look what's going to be holding true up to this throughout these downtimes. Okay. So our system is cash flowing, yet you're still growing your capital. Grow your capital. Growing capital while helping others, right? It's the best of both worlds. You know, we have many webinars talking about the help factor, but I'm just talking right now about growing the capital and what it looks like in this scenario during the coronavirus. And that's exactly what happened in all our portfolios. Okay. My name is Skye Logan. You all know me. Much adored host for today. But you want to find out how hard your money's working for you, or get your money working harder for you as opposed to you working. You know, maybe you got your full-time job being a landlord right now. You've set up a perfect world of being a landlord possibly, and you're just tired of that. You want to transition over to something different, or you just want to explore. What does it look like? Great. Reach out to me. I love talking to people, as you can tell. I love to talk. Got a free info pack. You can go to the equityhelp.com, our website. You can click anywhere in there. It'll start leading you right to me. My calendar's right on there. All right. You can look over different testimonials. We have a lot of client testimonials. We have family testimonials and videos, which are fantastic. Set up a discovery call. Give me 15 to 20 minutes to see what we can do for you. All right. So I enjoyed talking with you today. I look forward to catching you next week. You have the link, the webinar registration link applies to every single one of the webinars, the weekly webinars on Thursday, same time, same bat channel, same bat time. All right. Thank you for coming. Have a fantastic week.